Good evening, good evening, good evening. I hope everybody can hear me well. Give me 1 second just to make sure that we are live and coming through well. Awesome. And we are. Good evening, everybody. Thank you so much for tuning in. We're going to give you guys some time to jump on and to share this video. So take a moment to share this video, and we are eager to talk to you guys tonight. Oh, I don't think y'all can hear my music. I thought y'all could hear. All right. What's going on? Please share this video. I apologize. We are actually sharing to a couple of other groups and stuff as well right now. So while we get situated and share to these other groups, you guys take a second. Mr. Price, how's it going, sir? Can you hear me loud and clear? Give me a thumbs up if you can hear me. And while we get ourselves situated, enjoy the sounds of happy Mother's Day, everybody. All my mothers, Mother's All right. Good evening, great people. Good evening. Good evening. Guys, we're super excited to be joining you live today. Again, my name is Javertus Burnett. Most of you have seen me before. I am not Sharengio Marcus Robinson, but I am going to be hosting tonight on their behalf. So thank you for tuning in here. Listen, this is exactly what I want you to do. I want you to press share right now. Press share, start your watch party, do whatever you need to do. And we're going to have a very important conversation tonight. We started this conversation yesterday, and over on the Black Wealth Summages page, we started this conversation yesterday talking about building our family bank. So we're going to have part two of that conversation and get into some question and answer, because a lot of you guys left the conversation with some questions, and we want to dive into that. But first and foremost, before we do anything, I want to take some time and say happy Mother's Day to every mother. Happy Mother's Day uh, to the wonderful mother of my kids, my wife, Courtney. Happy Mother's Day. I know she's probably not watching this because somebody got to be with the kids right now while I'm doing this, right? We're in this quarantine world and they just don't know what bedtime mean anymore. So happy Mother's Day to my wonderful wife, Courtney. Happy Mother's Day to the most amazing mother in the world, my mom. You see, she did such a wonderful job, right, raising me. Happy Mother's Day to my mom, Willie Mae Brown. Love you, love you, love you. Happy Mother's Day to the mother in the Robinson coach world, Sharingia. Happy Mother's Day. Hopefully you're getting some rest and relaxing. And happy Mother's Day to all of my mothers out there. So if you are a mom, I want to do something special for you before this thing is over tonight. So if you're a mom, raise your hand in the comment section. Just comment, I'm a mom. And if you know a mom that's not watching right now, tag that mom. So comment, I'm a mom, and tag a mom in the comments. And we're going to do a giveaway. Let's do it. We'll do a giveaway for one lucky mother tonight at the end of all this. So I'm a mom, tag a mom, and we'll do a giveaway for a lucky mother tonight. So guys, we're going to talk about this concept of building your own family bank. Now, I know when we say those words, it seems far-fetched, it seems unfathomable, but it's actually a reality that so many have taken advantage of and leveraged for generations. And we want to have that conversation tonight. All right. So we want to have that conversation tonight. And while we're in the process of having this conversation, we're going to talk a lot about life insurance, and we're going to get any of your insurance questions answered at the same time. Any of your questions, we want to make sure we get them answered. So feel free to ask those questions. Now, what is this bank? What is this bank? Before we even start talking about all the fancy, exciting stuff that it entails, let's just tell you what it is, right? So the concept or the idea behind the family bank is comes from one of the places it comes from is an amazing book. What Would the Rockefellers Do? All right, What Would the Rockefellers Do? Phenomenal book. I have a couple of copies. If you want a copy, inbox me. I may have 2 or 3 more copies available. So inbox me after all this, but it's What Would the Rockefellers Do? And in this book, it tells us the journey of how the Rockefellers, and not just the Rockefellers, there's so many more families that we could name, the Kennedys, so many more, how they structured their personal family assets in such a way that they could not be outlived. So now by show of hands, and I want you guys to interact with me tonight, in the comment, raise your hand if you would love to set up assets in such a way that your children's children could not mess up, could not outlive, and would never have to, no generation of Robinsons or Burnett's or Johnsons or Jones, whatever your last name is, no generation of in your bloodline ever again have to start over. Imagine that. One of the things that my wife and I say all the time is that our ceiling is going to be our children's floor, meaning that we plan to have a mechanism in place that ensures that our children, A, won't have to start over financially, B, won't be able to mess up what we did, and thus comes into this concept of starting your own family bank. Now, what I want to do today that we talked about yesterday, but we didn't do yesterday, is we want to lay out step by step, how do we start this thing? And what does that look like? And what does it mean? Okay. So first thing first, how do I start this bank? The very first thing that you're going to do is you have to decide what type of trust that you want to set up and establish. So we're going to establish a family trust. So now it's my personal opinion that everybody, not just the rich and famous, everybody should have a trust-based estate plan, not just a simple will, everybody should have a trust-based estate plan. And what this does is the trust adds a level of protection and brings in a level of privacy and allows me as the person establishing the trust to set up some rules. Okay, so let's take a step back. What normally happens when someone dies? So hypothetically, I died last night in my sleep, and I can kill myself off. I won't kill nobody else off, but I'll kill myself off. But I always do it yesterday, right? I died last night. I could have a life insurance policy in place. I could have a will for like my 401ks and investment things and house and all this kind of stuff. Normally, even if let's say I have a healthy life insurance policy. So say, I'll use my I have $3 million in life insurance right now. My $3 million in life insurance and I died. Typically what happens, the wife gets some money, the children get some money, the university gets some money. In my case, Savannah State University, whoop, whoop, go Savannah State. Savannah State would get some money. My church family would get some money. By church family, I mean my actual church. My church would get some money. My nieces and nephews would have a little pool what they would get. And before long, I've split up this entire $3 million, right? I've split up this entire $3 million, and it's only a matter of time before the entire 3 million is gone. So let's say hypothetically, wife gets $1 million, kids gets $1 million, Savannah State gets 100,000, nieces and nephews get 100,000, church gets 100,000, couple 100,000 goes towards paying off bills, paying off a mortgage, doing all that kind of stuff, and a couple dollars stay in the bank, right? Eventually, we do what? We're going to spend that money, right? We're going to go out, we're going to buy a car, we're going to buy a house. The kids might, we're going to pay for college, we're going to do this, we're going to do that. These things are going to happen. And before long, the money is going to be gone. Now, it might take a while before all the money is gone. But one thing for sure, my great-great-grandkids, more than likely, traditionally, my great-great-grandkids wouldn't partake in that $3 million. That $3 million would be significantly less by the time my great-great-grandkids got a little piece of it, right? That's the normal way. Okay, that's the normal way. If we're going to create our own family bank, the first rule of creating our own family bank is do not separate the assets. I want somebody to say that with me. If you're watching this, I need somebody to type that in the comments. Do not separate the assets. Do not separate the assets. So JB, why do we not want to separate these assets? Why do we not want to separate these assets? So let's stay with our current example. It's my life insurance policy. I died last night. Boom, this money comes. For my wife, for my children, for Savannah State, for Faith Alive, for my nieces and nephews, that money's going to go to them tax-free, right? Now let's say the money's placed inside of some type of investment account, yada, 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 blah, 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 blah. Savannah and Josh will spend all their money and say, hey, Dad did a great job. We're going to use this and we're going to be debt free. And we're going to leave our kids our investment accounts and we'll spend this money now. So they spend that money. They leave their kids $1 million each in an IRA or 401k. Okay. The moment they leave that money to their kids in the form of an IRA or 401k, if they leave $1 million, we might be looking at anywhere between 500,000, 650,000 that they actually receive, because what? They have to pay taxes on that. And so every time I separate it, so let's say each one of my kids have 2 kids. So Savannah has $1 million in her IRA. She's going to leave it to these 2 kids. That's 500,000 a piece. But by the time Uncle Sam and the state of South Carolina get their hands on it, she's going to leave each kid about 350, 300, somewhere between 300, $350,000. And her goal was she wanted to leave 500,000. She wanted to leave $1 million to these kids. Okay. So the first thing we got to realize is not to separate the assets. When you separate the assets, we become vulnerable and our banking system begins to break down. So we want to keep all the assets together, right? So instead of allocating assets the way I did in that first analogy, in fact, let's go back. I died last night. Having a family bank, the proceeds from my insurance policy, 2.5 million of that would go directly inside of the trust. Okay? Directly inside of the trust, not to ever be separated. 500,000 of that goes to my wife to pay off the mortgage, put me in the ground, give to Savannah State, set some stuff aside for my nieces and nephews, and to my church. 500,000 is for that. This 2.5 million that the trust is a beneficiary of, the first rule, so let me slow down. Once we establish this trust, and a trust, like we talked about yesterday, is just a document. It's a legal document, right? That keeps my assets private, keeps it out of probate, keeps all this stuff, keeps it private. It creates a legal entity that can actually have access to assets. And this entity does not die when I die, thus giving us an extra layer of tax protection as this thing grows. So I have my trust established. 2.5 million goes into the trust. Once we have the 2.5 million in the trust, I now set up rules. So step two, first step is to set up the trust. Step two is to set up rules to the trust. And so you might be asking yourself, like, do you have to die to set up this trust? Like, no, you can set up a trust right now. You can establish a trust right now. It's a legally binding agreement, and the trust can be the beneficiary of life insurance policies. The trust can be beneficiary of 401ks and IRAs. The trust can be the owner, the deed upon death can be placed inside a trust for real estate and all this other stuff. So you can set the trust up right now. So the trust is set up, pass away, 2.5 million, boom, is now in the trust. Now we go to these rules of the trust, okay? So the first rule is we're not going to separate the money. That's rule number one. Summer typed that in for us earlier. Do not separate the assets. Rule number one, we're not separating the assets. Rule number two is the only way that you can get access to, and now let me give my disclaimer. These are my rules. You don't have to set your rules up like that. You don't have to do none of this stuff. But to make your bank more efficient, here's some tips and strategies that I think make a lot of sense. Rule number two, if you want access to the money, you must borrow from the trust. You must borrow from the trust. All right. So Summer, somebody help me out, put that in the comments. You must borrow from the trust. Okay. So why are we going to borrow from the trust? Why are we borrowing from the trust? What are we starting to do? What are we trying to do? What we're trying to do is build generational wealth, right? We're not talking about weekend money. We're not talking about next week money. We're not talking about vacation money. We're talking about generational wealth. And we're trying to establish generational wealth. And if we're going to establish generational wealth, we got to put some parameters in place to ensure that this money outlasts me. This money outlasts my kids. This money outlasts my grandkids. So rule number one is we're not going to separate the assets. Rule number two is in order to get money from the trust, you got to borrow from the trust. Okay. So now this looks like going to the trustee of the loan, going to the trustee of the trust, the executor of the trust, and borrowing money, filling out a request to borrow, right? They're going to fill out a request to borrow. There's going to be, it's going to be a demand, what we call a demand loan, meaning that no money is due to be paid back to the trust until the trust demands it, okay? Until the trust demands it. And for all intensive purposes, the trust isn't going to demand the money actually at all. Okay. And we'll get to that in rule number 3. You'll see why the trust won't demand the money. But it's going to be a demand loan, which means you don't have to start making no payments next week or next month or 2 months from now. And when we do this demand loan, it's going to be at a very, very, very low and affordable interest rate. It's actually going to be at the lowest rate possible, the government Fed rate, which is super low right now, which is typically somewhere less than 2% on average, typically. So it's going to be a super low interest loan, and it's going to be a demand loan, meaning you don't have to pay this loan back. Now we're going to get into more about, I want to stop right here for a second and talk a little bit about the psychology of it and why do it this way. All right, the psychology and why do it this way. One of the reasons why we want to do it this way is if I can get a plan and a system in place, if I can get a system in place, I don't have to ever worry about my family not having money again. Okay, so that's why we're going to do a loan, and we're not just going to give money away, because if we give money away, we're going against rule number 1, which is don't separate the asset, don't separate the money. Rule number 3, okay, rule number three. In order to get a loan, so we're not going to do any credit checks, we're not going to do any debt to income checks, we're not going to do any cash flow checks, we're not going to do any of that stuff for you to qualify for this loan, right? But in order to get a loan from, in this example, call it the Burnett Family Trust, in order to get a loan from the Burnett Family Trust, you must have an asset, you must have collateral, right? You must have collateral that the trust itself is the owner of. You must have some type of collateral that you can place in the hands of the trust, that the trust can be can have deeded to them, can be the owner of, can be the beneficiary of, can be the assignee of. There must be collateral. Why is this so important? This is going to make sure that my children's children have money to borrow from. Quick example. Savannah wants to take out $100,000 to start a business, right? Savannah wants to take out $100,000 to start a business. She borrows $100,000 from the trust. Her collateral ensures that if she doesn't pay this back, even if she don't pay the loan back, because remember, it's a demand loan. What if the trust doesn't demand the loan before she passes away? The collateral ensures that not only is the money repaid, but that bank should increase over time. Now, what are some acceptable forms of collateral? Now, this is important. What are some acceptable forms of collateral? My personal recommendation for acceptable forms of collateral is life insurance, number 1. So how would this work? So right now, we have a significant life insurance policy for our kids. It's not set up, however, at the moment, which it will be. That's going to be adjusted in the near future. Right now, the trust isn't the beneficiary of their life insurance policy, right? So we're going to have the trust be beneficiary of a portion of their life insurance policy. And to the extent that they have collateral, which in this case, the life insurance policy that the trust is the beneficiary of would actually count, they can borrow to the extent of their collateral. They can borrow, you can borrow to the extent of your collateral. So you have $1 million life insurance policy that the trust is the beneficiary of, you can borrow up to $1 million. Why is this? And let me say this too. Most of the time, you probably want to put some type of cap, say maybe 75% of the value of the collateral, or 80% of the value of the collateral, so that you don't fully exhaust the funds or the collateral inside of the bank. But you get the picture. We got this life insurance policy that the trust is the beneficiary of. Real estate, can be collateral. You can make your collateral whatever you want it to be. For me, acceptable forms of collateral is life insurance proceeds and real estate. And as you see this, once we get to a couple of steps down, you're going to see how after a while it starts to take care of itself. So rule number one, we're not going to separate the money. Rule number two is that if you want access to the money, you got to take a loan from the policy. Rule number three is that if you're going to take a loan, you must have collateral. Okay, you must have collateral. Rule number four is that none of us want to create trust fund babies, right? None of us want to create trust fund babies. And what I mean by trust fund babies is that the idea in the picture that we've all had in our head about trust fund babies, oh, lazy bums, they're selfish, they don't know how to work hard, blah, 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 blah. No, so we're going to put rules in place to prevent the kids from being the lazy, snobbish, rude, typical stereotypes that get thrown on trust fund babies, right? So for the rules, you get to decide what your rules are. Here's a sample of what that might look like. For me, those rules are going to look like, when we talk about we have to clearly use the funds for one of the approved reasons. That could be education, that could be medical bills, expenses, primary home ownership purchase, business startup and development, or matching funds. All right. Education, medical, primary home ownership, business startup or development, and matching funds. Somebody type this down for me. The rule that we can use: education, medical, primary home ownership, business startup and development, or matching funds. What I mean by education is just what I said. Savannah wants to take out a $50,000 loan for her daughter to go to college. Boom, that's acceptable. Medical, we have some type of difficulty, some type of health concerns, health issues. We got some expensive medical costs. Boom, that can be done. Primary home ownership, just what it says, primary home ownership. You get ready to buy a house. You want to use a down payment or even buy the house. All right, that's it. Number four, business development and business growth of startup and development. Start a business, grow a business, get into real estate investing, whatever it is that you want to do. Most people have questions about the matching fund. Yep, I already got a question about matching fund. Montez, great question. So what matching funds are is, my mom is a teacher, my wife is a teacher, my mother-in-law is a teacher, I was a teacher, I was an educator. So we have a family full of educators. If my daughter or my son says, hey, I want to be an educator, there are going to be matching funds there in place to match their salary so that they can do what they love doing without finances being a determining factor. Without finances being a determining factor. So if my daughter goes out, let's say Joshua goes out and he decides he wants to be an educator, and he starts out and he's making $45,000 a year, I don't want him to say, I don't want to be an educator because they don't make enough money. If that's what his heart wants to do, if he wants to be an educator, I want him to be an educator and be the best educator he can possibly be. If he wants to be an artist, I want him to be the best artist he can possibly be and not have this starving artist mentality or this starving artist syndrome. So if he decides he wants to be an educator and we got his starting salary is $45,000 a year, the matching funds will be used to match his salary of $45,000 a year, bringing him to a total of $90,000 a year as an educator, which I think most educators, if you're an educator and you're watching this, you would agree that's not a bad deal to start out your first year in teaching, right? So that's what the matching funds are for. That's what the matching funds are for, Montez. So those are the rules that we can access. These are the reasons why we can access money. And again, we're going to access this all on the basis of loans, right? Next rule, and this is probably the most important when we start thinking about legacy, long-term, generational, right? Legacy, long-term, generational. So important rule. Every Burnett born to Savannah and Joshua, every Burnett born to Savannah and Joshua, if you set something up with your siblings, every family member born of each sibling, you can set it up with your sibling, right? Every Burnett, I'm just using this as an example, every Burnett born to Savannah and Joshua on the 15th day of life for them, every child born after Savannah and Joshua, there must be the maximum life insurance policy purchased on that child at that time, and the trust will pay for it. So the trust will be the owner, the beneficiary, and the payee of that life insurance policy. So what does this look like? Savannah is married, she's 30 years old, and she has a child, or she's 25 years old and have a child, whatever. She has a child. On that day, well, once 15 days old, once the baby's 15 days old, in order for that child to have access to that trust, Savannah needs to purchase the maximum available life insurance on that child's life at that time, and the trust will pay for it. Okay? Now, what does this do? This takes us into sustainable generational mode and at the lowest possible cost imaginable. This is going to get us to the point where this thing starts running like a well-oiled machine, right? It's going to start running like a well-oiled machine. Let's walk through a full example. We have the trust set up. We got the rules. We've chosen how, I'm sorry, I left the last step. We also, well, it's actually one of the earlier steps, but I skipped it. The one of the earlier steps that I skipped, that I just assumed because I assumed you guys watched this yesterday, but most of y'all didn't see this yesterday. So the other step that I have to take into consideration is early on, I have to decide how I want to fund it. I choose for cash value life insurance to be the way that ours is funded for several reasons. Number one, I want something with some guarantees. Number two, I want something that's off the market. That's so let's say I needed to tap into this money March the 14th of 2020, right? Well, we saw a 30% drop in the market March 14th. So if I had $1 million in and it was all in the market, it would have only been 700 at that time. And if I needed $1 million, or even if I needed 800,000 to take advantage of development opportunity with someone, I would not have been able to take advantage of that because of at that time, because of the losses in the market. Now the market has since rebounded a good bit and earned a lot of that, close to 15, 20% of that back. But we can see how that will be an issue. So that's why I choose to fund with cash value life insurance until you are able to purchase cash value life insurance. Now, cash value life insurance is far more expensive than term. So until you're able to purchase cash value life insurance, you can start the thing with a term policy. So the most important thing about life insurance is having the right amount. So if the amount of life insurance you need is $1 million of life insurance, that's the most important part, having the right amount. And even if it's a term policy, the trust can still be the beneficiary. And at any point that your budget allows, you can start converting little pieces of that over to whole life. All right. Now, I know we've been talking a lot, so I want to take a couple of questions. Montez mentions, how long does the matching funds last? That's a great question. This in the trust, you get to set the rules. So Montez sets the rules for all this. You might say we're going to do matching funds for the first 5 years, or you might say we're going to do matching funds until you're debt free, or you might say you're going to do matching funds indefinitely. It's just you set those rules, Montez. But great question. Any other question? I know I've said a whole lot. Any other question? I'm gonna take a breather from talking. Any other questions? I want to hear. Let us get those questions. Everybody with us so far. Is it making sense? Let me see. Let me know that this stuff is making sense, because there's nobody on here with me, so I can't see y'all faces. I can't do none of that. Give me a thumb up or heart or something. Let me know this is making sense. All right. And if you got a question, get your question in the comment section. Get your questions in the comment section. Oh, Sharindria, I'm sorry. Okay. Ooh, let's slow down. Let's slow down. Let's slow down. Let's slow it down. So we're going to establish the trust. Sharindria, you can literally get started today. We will, let's carve out some time to talk this week. And we'll walk through getting started and what that looks like initially. So great question. Any other questions? A couple of other things, a couple of questions that I often hear that I want to dive into, but I want to hear from you guys before. And there's a little bit of a delay from me to y'all, so that's why I'm pausing a little bit. Thank you, Montez. I appreciate that, man. I appreciate it. All right. So let's start with the most common. The most common challenge, Sharindria, text me that. OneTrust. So I want to get to Summer's question first. So Summer says, how do you start? You literally start by setting up and establishing the trust. First thing, once you decide how you want to fund it, if you know you want to fund that with life insurance, you start by getting the right amount of life insurance for you, getting the right amount of life insurance. And so there are three simple ways that you can find out how much is the right amount of life insurance and be about right. Okay. So Summer, this is for you. So, and for anybody else that's watching, but this is to Summer's question. The first way is just a general rule of thumb, right? So if you've ever read Wall Street Journal or looked at Forbes magazine, what they say about life insurance, or heard listened to Susie Orman or Dave Ramsey or any of these folks, everybody in the finance world agrees that you probably, a good starting point, if you have no clue how much life insurance you need, a good starting point is probably going to be 10 to 12 times your income, right? 10 to 12 times your income. So if you make $50,000 a year, you should have a minimum of $500,000 of life insurance, right? So Summer, when you purchase your $500,000 of life insurance, you begin to put your plan in place then. This doesn't happen when you die. When you die, typically the first large influx of cash is going to go into the trust. That's when the first large influx of cash goes into the trust. But you're going to start this thing right now. You can start it right now. All right. We're going to decide how we want to fund it. If that's life insurance, we're going to make sure we have the right amount of life insurance. The one way we determine that is just the general rule of thumb, 10 to 12 times your current income. You can make $100,000, you need at least $1 million of life insurance. Second way we decide that is by what we call an asset analysis. How much debt do you owe on your home? Do you have any student loan debt, credit card debt, car debt? How much debt do you have that's going to be left to your spouse or your kids should you die today? Once you calculate that, we say, once we calculate that, we go into the next thing is how much is it going to cost to bury you, put you in the ground. I typically tell people to take the cost of the funeral plus a little bit extra, because most of the times, if I died last night, the reality is my wife probably not going to work tomorrow. Probably don't feel like Zooming and doing all this other stuff. So we need just some emergency cash just for that. So have those things. The third thing that you want to take into account if you have kids is, do I want to cover their college education, to make sure that their college education is covered without any student loans. And the fourth and final thing, but oftentimes the most important, is income replacement. Do I want to replace my income for my spouse until the youngest child is out of college, out of the house, out of the pocket, off the payroll? So when you add up how much money it takes to do those four things, how much debt do I have? how much this funeral gonna cost. Thank you, Montez. He said the average funeral is 10K. So I need 10K for this funeral, and then probably another 5 or 6 just to make sure I got adequate cash to where if I don't want to go to work next week, I don't have to go to work next week. If I want to take a month off and grieve my family member, my loved one, I can take this time off to grieve. So, and then do I want to cover college costs for my kids? Number 3. Number 4, do I want to replace my income to the youngest child is out of the house? So you got a 10-year-old. Typically, they're done with college around 22. Might not be totally out of your pocket to 25. So we just say, hey, I want to replace my income for 15 years. You make $100,000 a year. You need 1.5 million just to replace your income till that child is out of the house. All right. So that's the second way that we calculate. The third way we calculate our life insurance need is what's called the human life value. That's just me saying legally, if retirement, what age I plan to retire. So for easy math, I'm gonna say I plan to retire at 66, right? Well, I'm 36 today. So I take the age I plan to retire minus my current age of 36, that's 30 years. And for easy math, let's just say I make $100,000 a year. 30 times 100,000, I need at least $3 million of life insurance. All right. So that's kind of how, those are the different ways to come up with how much life insurance you need, which is the most important part of this puzzle. So to Summer's question, you started right now. And when we die, that's just when we get the first abnormally large influx of cash, right? You can have accounts that the trust owns. You can have checking accounts and brokerage accounts, investment accounts that's growing, that you have access to, that the kids have access to, all that kind of stuff while it grows. I love cash value because the value does grow inside the policies as well. So that's stuff that you can access while you're living. You don't have to be dead to access that. So that's how we get started and how that works. All right, so great question, Summer. Great question, Shirendra. You just need one trust, Shirendra. You can set your rules for each child. You can have different rules for different kids. You just need one trust. You can have as many rules as you want within that trust. This is especially important. Hear me loud and clear. If you have a blended family, this is especially important for you. If you have a blended family, you want to make sure that every child, every person that's involved in this relationship and in this family blend is taken care of properly, and that nobody's taken advantage of or left out in the cold. So I want to get to this because I think it's a really good, a really serious point. Most of the time, the question that follows is, well, JB, this sounds amazing, but I'm older, right? This sounds great, but I'm 50 years old now. I'm 60 years old now. I'm 70 years old now. I want to talk to us real briefly about the concept of borrowing a life. Somebody type in the comments, borrow a life. Borrow a life. Borrow a life. Guys, I can't stress to you how important this is. So if you're watching this with your family, if it's you, your spouse, your kids, if it's you, your spouse, your kid, yes, Montez mentioned updating the trust as our family structure changes. That is absolutely vital. We have to update this trust as our family structure changes. And another thing I want to mention about the trust, I mentioned earlier that the trust doesn't die. So typically, the trust will live. And again, before you, this is not quote unquote personal legal advice. Please talk with your attorney. If you do not have an estate planning attorney, I can connect you with a really, really great one in most states. Especially if you're in the Southeast, I have really cool estate planning attorney friends in pretty much all of the Southern states. In a couple of Midwest states too. But wherever you are, I can connect you with a really good estate planning attorney. The trust typically lives 99 years beyond the age of the the 99 years after the death of the youngest member of the trust, the youngest beneficiary of the trust. So 99 years after the death of the youngest beneficiary of the trust. If we continue to update it properly, it could live forever, theoretically, right? Some famous trust that we've all heard of, the Kennedy Foundation. You know, every time a Kennedy baby is born, that baby, $10 million of life insurance is purchased on that baby and the trust pays for it. All right. Summer, great question. Do I need a trust if I don't have a spouse or kids? Can I have enough life insurance to cover final expenses and all of my bills? It depends on what your goals and objectives are. If your goal is not to leave a legacy, not to build generational wealth, then you don't have to. But I think everybody needs one, even if you don't have a spouse, even if you don't have kids, for several reasons. Number one, you might want to leave your legacy some other way. Your legacy might not be in the lineage that comes from you directly. Your legacy might be, I want to do something to drastically change the way law enforcement is handled in our country. So you may start the Summer Snipes Foundation that's able to provide some type of advanced training for law enforcement, or some type of advanced training or support group for men and women who are being released from prison. Like your legacy might look different, but I believe everybody has a desire to leave a legacy and to live for something bigger than themselves. So I think everybody should have one, but nobody has to have one. But I would recommend, even if you don't have a spouse or kids, Summer, I would recommend to have one. A lot of people talk about, I'm older, I'm further along, blah, 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 blah. This thing is expensive. Listen, life insurance is purchased with your age and your health. So first things first is I recommend every person going out and getting the amount of insurance you need. Get a term policy that you can afford, that you can later on transition or convert into a whole life product if you want to in the future. But get the amount that you need. So let's look at this example. Imagine you and your sibling group go in, and I'll use me and my siblings for an example. So let's say hypothetically, me and my siblings say we're going to start the Burnett Family Trust. And this trust is going to be for the benefit of our kids and all kids born into our bloodline for generations to come. Okay? We might not all be able to go out and buy $3, $4, $5 million worth of whole life insurance right now. But the first step that we would do is we would make sure every parent, every adult has whatever amount we agree to. So let's say we agree to $1 million. Every adult would have to have at least $1 million term policy that the trust is the beneficiary on. Boom, that's done. We then say, put a number on the kids. Say every child got to have 100,000 or whatever. Boom, that's now done. That guarantees the longevity long term, right? But then we might say, well, let's buy the absolute maximum amount of life insurance legally that we can on the matriarch or patriarch of the family, the healthiest matriarch or patriarch of the family, right? Because life insurance, again, is purchased with your health, not your age. So my siblings and I did something similar to this a couple of years ago, where between the four of us, we said, mom is underinsured. She doesn't have the right amount of insurance, but she had what her budget could afford. We said, let's layer that and do something extra. So we went in and we paid the monthly premiums every month for our mom's insurance policy. Now there has to be an insurable interest and all of that stuff. Like that has to happen, in which with most parent-children relationships, they're insurable interest. But my three siblings and I paid the premiums. So now we did not do this. So we didn't do this. This is just hypothetical. But let's say that policy was a $5 million policy. And let's say over the course of mom is still young and healthy, just turned 65. Again, shout out to mom. Happy birthday. Happy Mother's Day. Turned 65 yesterday. Let's just say for kicks and giggles that over the next 30 years, say mom live a long, healthy life out to 95 years old. And over the next 30 years, let's say it cost us $500,000. It cost us $500,000, but we would have literally transitioned that $500,000 into $5 million tax-free. And then that 5 million, part of it could go to whatever mom wanted it to go to. And let's say 2.5 million would go into the Burnett Family Trust. Now, the grandkids of Willie Mae have 2.5 million that they can leverage to get a leg up in life, to start a business, to go to college. I want you to sit and imagine, what would life look like for you at this point? And for those, some of you will be like, this is your reality, but for some of us, it's not. But what would life look like for you at this point if you had zero student loan debt, if you had zero mortgage, if you had zero business debt because your family funded your business, and you had an opportunity to dream? You had an opportunity to dream without failure being an option, right? You had an opportunity to actually dream and be creative without failure being an option. Would your life look different today? And do you think that if somebody set up a family trust that had $2 million or $1 million or however much in it that you had access to, would your today look a little bit different? Now, I know we're all super amazing and grateful people, and everybody's grateful for where they are. And, oh God, well, we thank you because my struggles made me who I am today, and da, da, da. I get all that. But the best students learn from others' mistakes, right? Right? So I would have much rather my mom told me the stories about the days when, get it? Instead of having to live in the days when, you know? And so that's a viable opportunity. We can actually go in and borrow, not just borrow this life, but we can go in and we can chip together. So in many cases, I recommend, when I do have families that sit down that want to do this, we go through the preliminaries and we do term applications for everybody, right? We do term applications for all the people that want to be a part of it. And then once we find out their health record, it comes back, we get the policies approved, all this kind of stuff. We take that patriarch or matriarch, and instead of everybody else paying for expensive whole life, we say, guys, let's just chip in and let's get $2 million policy on Mr. Jones. He came back at a non-smoker rating. Let's give a $2 million policy. Yes, it's going to be costly because he's older, but everybody else got simple term policies that they're paying $20, $30 a month for, and we're chipping in this extra towards Mr. Jones. Now, when Mr. Jones passes away, we get this huge shot in the arm influx where we can then take that shot in the arm, make sure we keep the term policies going. We can even pay for the term policies from the trust if we want to. And now we do the same thing with the next patriarch, matriarch. We take that person, and now because everybody got term already, we're just going to be converting this policy now to whole life to ensure that it's going to be around forever. And we take a lump sum and pay for that sucker up front, and so on and so on and so on. So now every generation, there's more money in the trust than less money in the trust. All right. All right. So guys, our time is almost up. I know we're running out of time. The other thing, if you're watching this and if you are that matriarch or that patriarch and you don't have quality health, you know, there's some severe health issues or some health challenges, that borrowing a life works the opposite way as well, right? We can take a grandchild or a great grandchild or a child, and you can fund the policy on them. We can stuff extra cash inside of it, letting that cash build up. And when family member XYZ does pass away, we got all this cash we can pull from to help bury them if they're uninsurable. And that's when, in my opinion, that's when the final expense policies make a lot of sense. The guaranteed insurability policies make a lot of sense. And those are typically smaller in nature and smaller in structure. So there are some really, really different creative ideas that we can do. Guys, I hope this is making sense, because I ain't got nobody on here to talk to me and talk with me, but I hope this is making sense. Hope this is making sense. I told you guys to Summer, inbox me, give me a call. We can make that happen. We literally can make that happen in less than 15 minutes. We just got to have a phone conversation. Now, I will say this, life insurance is purchased with your age and your health. The younger you are, the better it is. Have something outside of your job. I can't stress that enough. Have something outside of your job. There are currently 33 million Americans who had life insurance at their jobs as of right now who are now unemployed. So have something outside of your jobs that you own, that you control. And if you're young and you're healthy, I mean, I just did $1 million life insurance policy for a young, healthy 35-year-old female, and she pays $30 a month for $1 million life insurance policy. $30 a month for $1 million life insurance policy. So it's affordable. If you're young and healthy, it's super affordable. All right. Well, guys, it is 9:58. I don't think I have anything else. I ain't looked at my notes. I wrote these notes down and didn't look at not one of them. Make sure I said everything that was on my notes. I said everything that was on my notes. Mother's Day. There are, let me go back and see, did I have any moms say, I'm a mom? Let's see if I had a mom say, I'm a mom. Summer, don't judge me. All right. So I need all my moms to say, I'm a mom. All my moms to say, I'm a mom. We're about to do a quick giveaway. We're going to do a quick giveaway for one lucky mama right now. We're going to do a quick giveaway. I need somebody who's not a mama. If you're not a mama, raise your hand. I need somebody who's not a mama. I got you. I got you. I got you. Awesome. Summer. Summer is not a mom. Summer's going to help us out. Okay, Summer. Here's what I need you to do, Summer. Summer, I need you right now to text me. Text me. And I'm going to put my number in. Let me do that first. So I just put my number in the comment section. Summer, I need you to text me right now a number between 1 and 10. A number between 1 and 10. Summer's going to text me a number between 1 and 10. And I need all of my moms that are on here right now, just begin to put your number, your own number. Summer, don't go texting your favorite mom that's that's watching right now either, what the number is. But all of my moms right now, put a number in between 1 to 10. Put a number in. Hurry up, hurry up, hurry up, hurry up. This is going to be the last thing we do. We're at our hour. Our hour is up. While they're doing that, I want to thank Marcus and Sharendria. Thank you guys so much, Robinson Coaches, for trusting me to have the conversation with the wonderful followers of Robinson Coaches. It is so much fun. I have so much fun whenever I'm with you guys. It is truly an honor and a blessing just to be on this platform. And I don't take it for granted. I absolutely love you guys and care about you guys. And I'm so grateful for all God is doing in and through you. And so thank y'all, thank y'all, thank y'all. Okay, moms, I need to see y'all. I need my moms. I need my moms. Place a number 1 through 10. All my mom's going to put a number 1 through 10 in the comments. The mom that is the closest to Summer's number will win. will win our giveaway. Will win our giveaway. All right, moms, come on, moms. Y'all got, I'm gonna, 1 minute. 1 minute remaining, moms. 1 minute remaining. I saw some folks say that they were moms. I saw some folks say they were moms who have not put their name in yet. Shakia, we waiting on you. We waiting on you, Shakia. And guys, if you found this conversation beneficial, please share this video, tag some folks. We're here to be a resource. I put my phone number in the chat, but I'm available 864-360-6723. Feel free to give me a call. Let's have the conversation. In addition to the phone number, definitely visit a brand new website that is still being developed and still being worked on. www.werevealwealth.com. The company is based in Maryland, but I will be running the company for South Carolina, Georgia, and North Carolina. So super excited. Still have an amazing partnership with New York Life, and I'm excited about that partnership. Things are just really blossoming, and this just gives us an opportunity to serve more people in a better way, more efficient way, especially on the managing money side. So our managed fees are a lot lower now that we've made this merger, and I can't wait to help you guys solve those problems. All right, let's see. Oh, boom, got it. Got it. Okay, all right, so let me go see. I don't know what Summer sent me. Let me go see what Summer said. That is not right. Summer, really? Seriously? Really? That really just happened? Okay, so Summer's number is 7. Summer's number is 7. So yeah, Sharindria Robinson in that case would be our winner. But I'm gonna veto that. Sharindria, I love you. Love you so much. But we're gonna go with Shakia since she was the closest to 7. I can't be on the Robinson Coach platform and give a prize to the Robinson Coach. Like, no. So, yeah, Shakia, you have won. So inbox me or text me your Cash App or put it in the comments. No, Sharindria, no. Shakia, you win. Shakia wins. That's I know you weren't gonna keep it. I know you weren't gonna keep it. Great. Shakia, no, Montez, no. This is Mother's Day. Montez, you did not win. She won. She won, Montez. Okay? Okay. Guys, thank y'all so much. This has been absolutely wonderful. I've loved spending time with you guys. It's 10:05. We have to go, but please tune in next week to Robinson Coaches as there'll be another stimulating and exciting conversation, and you will not want to miss it. Guys, have an amazing day. Be blessed. Have a great week. And don't forget, whatever you do, go out, build wealth, leave a legacy. And until next time, I'm JB. My contacts in below. If any of this stuff is interesting to you, let's have the conversation. Let's have a conversation. Love y'all. Bye.